Hello, everybody, and welcome to the October edition of the LWC Investor Presentation. I'm your host, Chris Kerlow, joined today by our moderator, Mitchell Shields, who will be fielding questions in the chat, so feel free to throw anything in there that you'd like me to address at the end of the conversation. I'll go through the presentation and then get to questions at the end. So you'll see that we've rebranded our slides with the rest of Canaccord Genuity. Looks pretty slick. Be a second to read our disclaimer and move into it. So the market downturn continued in September. Was the worst month since March of 2020. Obviously, the start of the coronavirus pandemic. Prior to that, we'd have to go all the way back to the great financial crisis. The S&P was down significantly more than the TSX, over about 9%. TSX was not quite that bad. Fortunately, in the last 2 days, we've seen a very big reprieve rally of 5.7% on the S&P 500, followed closely by the TSX, just showing that, even missing 1 or 2 days in these markets can be meaningful. The typical annualized return isn't much more than that. We started today's session pretty poorly. Bounce back, was briefly positive, and I just checked right before this presentation. We're going to end it a little bit lower, but holding on to many of those gains. The reason we saw that bad of a sell-off in September was largely fueled by a conversation Jerome Powell had following the FOMC meeting, where they continued to talk about their war on inflation. We saw inflation numbers, albeit lower than prior months, at 8.26% in the United States, 7% in Canada, still pretty eye-watering levels. That was really what drove things lower and is what caused this relief rally in the past few days. We saw the Purchasing Manager Index, PMI, go lower than expected. So it's one of these situations where we're looking for weaker than expected numbers in some of these facilities. Manufacturing Index, you would expect to be good if it went higher, but in an inflationary environment like this, the market's looking for lower numbers. Same thing on the job side. We saw a 10% decline in job openings. Job openings is one of the better data points in labor statistics because it's closer to real time. The actual unemployment number takes time to produce. It's very backward looking, not overly popular. It's also why we look at survey data. This chart on the bottom here is showing a couple of surveys of consumers looking at the possibility of missing a minimum debt payment. That's continuing to tick higher, along with the probability of the chance of a job loss. The unfortunate reality for both the FOMC, the Fed, as well as the Bank of Canada and central banks around the world is we're likely going to have to see these unemployment numbers tick higher before we see the end of those rate hiking regimes. Not what a lot of people want to hear, but as investors, it's just the stark reality of the situation we find ourselves in today. The chart on the right side is WTI prices. You saw those peak at almost $130 a barrel intraday back in June. That's come all the way back to the low 80s. That's a good forward-looking indicator for inflationary data as well, because oil is the feedstock for many of our goods and services, as well as obviously the transportation industry. We really, as I mentioned, unemployment, those numbers still remain sticky. We saw the unemployment numbers tick up slightly by about 20 basis points, but a lot of that was attributable to people coming back in the labor force, arguably motivated by higher wages. This next slide I title, "Don't Fight the Fed." It's a popular mantra in finance and where we find ourselves today. And then I gave a little bit of a rope-a-dope analogy for you boxing fans of the late, great Muhammad Ali, who would play defense, preparing for a strong offense when the time was right. That's what we've been doing here with our portfolio changes through the month of September and really throughout the summer. Kind of a barbell strategy is a way we also would describe that. In our fixed income portfolios, we've been reducing duration risk by moving some of our longer term government debt securities, particularly on the US side, and converting those into Canadian dollar floating rate debt. Those benefit in a rising rate environment. Also takes a bit of credit risk, which is that rope-a-dope approach, giving us a little bit of torque should we move forward, as well as seizes a little bit of gains on this US dollar, which has run obviously pretty hot for you snowbirds that are looking at converting some CAD to USD. Not so bad for us when you look across the Atlantic against the British pound and the euro. We've actually done quite well. So there's opportunities that we're looking at there to take advantage of the dollar strength in those cases. We've also sold some of our short-term government bonds. As you see in the chart on the bottom right, the expectations for rate hikes going forward have continued to rise by central bankers. The Fed and central banks around the world tend to be like steering a cruise ship. It takes a while to move in one direction. They often move too far and have to come back. The last couple of days, I've heard more and more pundits coming to the table that they think maybe the rate hike cycle's ending soon. I would argue that we probably have one or two more at least getting us into the end of the year. I spoke about that in more detail in a Financial Post article interview I did a week or two ago. We'll send out that replay along with this and the slide deck for all of you on the call here today. That's actually brought up a new acronym. We love acronyms as finance geeks. TARA is the new acronym. There are reasonable alternatives. This comes off the back of TINA, which was the situation at bay for many years as you were in a low to negative interest rate environment where fixed income was very hard to justify. We're starting to see more opportunities there for the first time, probably in my investing career, as bond yields have only moved lower over time over the last 15 or 20 years that I've been doing this. One other move we've been making is in the small cap names in our portfolio. We saw a lot of opportunities in years past and almost all sectors were working. That's not the case right now. It's a very challenging environment for small cap stocks because the access to capital has really dried up. So we're really concentrating into a few high quality names where we've done due diligence meetings with all the CEOs of these positions. It's also giving us the chance to tax loss harvest and some of the other ones that may not be bad companies, but just have a chance for us to move into a few names, gain those tax losses to offset future gains from prior years, and also going into the future. So that's the wrap on the market. I wanted to move into now a subject matter that's one of my favorites. I've been a student of and taught this for many years now. It's behavioral finance. That's really the mix of psychology and economics. It's a bit of a social science, and so it's not as proven in numbers, but I'm a bit of a mathematical thinker, and so I'll try to describe it with a couple examples here. One of the most widely accepted theories is something called loss aversion, where a loss is perceived by individuals as emotionally more severe than an equivalent gain. Studies have shown that a loss can hurt twice as much as a gain. I'm showing that graphically here on the bottom. But I'll describe it kind of in an anecdotal example. You give an investment advisor $1 million cash. In the first year, they make you 100 grand. You're excited. That feels great. 10% return, fantastic. The next year, they make you another 100 grand. You're like, all right, 2 back to back, 3. Start to get used to it. 4, 5, 6, 7. By the 7th, 8th year, you're just kind of expecting that 100. If it was less, you would be disappointed. If it's 100, you're kind of flat line. You see that line taper off to the right. Conversely, you give an advisor $1 million, they lose you 100 grand. That doesn't feel too good. You lose it 100 grand the next year, you start to get a little concerned. By year 3, you lose 100, you're pretty worried. By year 4, you're near panicking. Year 5, things are getting worse, all the way down to 0. That feeling intensifies on the way down. That asymmetry actually is quite normal, natural, but presents opportunities for us as institutional advisors and investors as we can put these emotions to the side and manage money forward looking. That brings me to my next bias I'd like to describe, which is the anchoring bias. This is a cognitive bias where decisions are made or influenced by a reference point or anchor. In investing, many people get anchored on their purchase price. They either want to make it double from there, if they're underwater, get back to that purchase price, or maybe not lose more than 50%, when all of that is relatively irrelevant. It doesn't matter what your purchase price was. It's where are you today, and is it a good investment going forward from here on an after-tax basis? As institutional portfolio managers, we don't have that same anchoring bias. It allows us to do a less emotional, more thoughtful job as investors. We always look at things on an after-tax basis, but I'm trying to show that in an example here on the bottom left. There's 2 securities in the blue and the black, stock 1, stock 2. They may or may not be the stock charts of Apple and Google. What I'm trying to show is 2 similar opportunities where you're invested in these 2 stocks. You go from, let's say, the start of the year or 150 days after the start of the year, you're down about 25 grand in either position. What do you do as an investor? A lot of people would say, well, I want to get back to break even, then I'll get off of it, or I want to at least make back half of these losses. Well, in this same situation, we're looking at stock 1 and 2, Apple or Google, and our outlook is the same. We think both stocks from this point have a chance of doubling over the next 150 days. What should you do? In that situation, you should release the anchoring bias, sell your one stock and buy the other because you realize a taxable loss. And so investor 1 does that. They sell it day 145 and buy stock 2. Investor 2 just holds. After 300 days, the stocks have gained 50% from the starting position or doubled off the bottom. Investor 1, though, is up 49.5. Investor 2 is up 45.8. It's almost a 10% difference just because investor 1 didn't have that same anchoring bias. And this is something that we try to bring to our portfolio management techniques. We've had clients come in at all different points into our positions. We can't think about a certain spot. When we look at things from a tax basis, we make considerations, but we really look at the outlook for each individual position. The next and last bias I'll talk about here today is something called framing bias. This is when people make a decision based on information, the way information is presented, opposed to just focusing on the facts. The same facts presented in 2 different ways can lead to 2 different decisions. This happens all the time. It's how Google and Facebook are who they are. The way they're advertising to you, they're framing things in a way they know you like, and they continue to do so. In investing, one of the big things is not to allow that biased information, searching out information that you want to hear. You want to hear good news about a stock. When I'm doing an analysis on a stock, I go to the least favorable report I can find and see what does this person think that I'm not thinking. Try to really have those opposing views. It goes a long way. One of the good examples, you're all probably watching popular media that has discount brokerage advertisements where you can retire richer by saving 1 or 1.5% from working with an investment advisor. But it doesn't take into consideration all of these buy and sell decisions, the emotional aspect of investing, the fact that you need to be fearful when others are greedy and greedy when others are fearful, as the great Warren Buffett once said. That's really hard to do. The reason we're all here today is because our ancestors were faster running away from that lion on the Sahara or wherever that may have been. In investing, we really need to run at that lion. That's when the best opportunities present themselves. But that information of 1 to 1.5% is also framed in a way of making it sound like a big number. What I'm showing here in the chart on the bottom right is the S&P 500 daily range from the low to the high of the day. It averaged over 2% every day. Today, another 2% swing in the markets. If you're out of the markets for 1 day, that could be 2 years of fees. 2 days, making tough decisions. All of this emotional biases are very tough to overcome by ourselves, and just talking about it, understanding them, helps lower that. And that's what we're here to do to support you and all of our clients. And don't forget, investing is a zero-sum game. You're buying from someone who's selling, you're selling to someone who's buying. Do you know more than them at the person on the other side of that table? Have you done more work? Are you doing this all day as a profession, or are you just going on a gut or an instinct or an emotional reaction? And the influx of retail investors during the pandemic has brought a ton of amazing market inefficiencies for us as professionals to improve our risk-adjusted returns, and something to also keep in mind as you move forward. So that's it for our behavioral finance lesson today. Hopefully you enjoyed my thoughts on the market. And with that, we'll wrap things up for this month. See you all again next month.